Very few people think that way. Very, very few people, and it's one of the secrets, one of the simple secrets.
You shameless cloner. Want to track portfolios of famous value investors like Warren Buffett? See their buys and sells, current and historical holdings? Just visit valueinvesting.guru. It is valueinvesting.guru. Link in the description.
What's another part of Buffett's strategy that he talks about? Is portfolio strategy. Right. Right. In other words, now he has to have some more names, but he's very concentrated for the amount of money he has. But if he had a small amount of money, he probably wouldn't own, 30 stocks. He'd own maybe at most 5 to 8 different opportunities. He's actually owned 40% of a company. We're going to have a whole class about portfolio management, but one of the ways to make money, one of the ways that we've been able to make money over time is two. One, we've stayed small. Two, we've stayed very concentrated. We concentrate on the 5 or 8 positions that we feel the most confident about. And the best example I have of that is really, Buffett's example of you walk into town, you wouldn't go buy 30, there's 30 different businesses in town. If you just sold your business for $1 million and you wanted to reinvest in some of the businesses in town, would you just take an equal stake in all 30, or would you try to analyze them? And would you feel better if you were good at analyzing businesses? Wouldn't it be better to pick 5 or 7 of the businesses? Let's even talk about 5 businesses, just real quickly, because we'll have a class on this. If we talk about 5 businesses, and you put $200,000 into each, you analyze the 30 businesses, you picked your 5 favorites and put $200,000 of each. You had just sold your business for $1 million. Well, you had all your money into one business. Now you're picking 5 businesses that you think are very good businesses in town, that will be there for a long time, that have steady earnings, that have good clientele, that maybe some of them have a brand name or just a long-time business that you feel comfortable with. Does that sound risky, dividing that money up into 5 different places? To me, it doesn't sound that risky, and that's why all the discussion about standard deviations and volatility and beta and all those things just sound silly to me. In other words, if you really, really believe what Buffett says, which is, I am buying a piece of a business, okay? I'm buying a piece of a business, and if I bought the whole business, I'd be paying this, so I'm buying a piece of it at that valuation, and I think that's 50 or 60% of what I think the business is worth, and I do that 4 or 5 times. To me, that's prudent investing. And once you start worrying about how the pricing of those businesses will jump around over 6 and 12-month periods, it starts to sound ridiculous. I mean, really analyzing risk that way, which is how most of the institutional investment world analyzes risk, starts to sound completely ridiculous. And I think I would always, whenever you get in that discussion, which you will be, what was your Sharpe ratio, what was your standard deviation, all those different things. If you're really thinking about you're owning a piece of a business, you would never think, if you were a real estate developer and owned 5 different properties that you thought you bought cheap, or whatever, the rents were paying me such and such 15% a year, and I was able to buy it at that valuation, and I bought 5 of these. Would you care how it bounced around, over a year and 2 period? You wouldn't even think of it. And it's the same way with businesses. And it's very important to think about, because very few people think that way. Very, very few people, and it's one of the secrets, one of the simple secrets, is really to look at your portfolio that way, just a group of businesses. And you probably wouldn't want to own 30 different businesses if you could actually do the work. If you're doing a PE strategy, low PE strategy, then you sort of want the average return. So you got to own a lot to get the average. But if you're actually doing work on businesses and understand them and understand that you're buying discounts, then you can really own a few. Yeah.
So from that point of view, do you think that business schools will ever stop teaching efficient market theory and diversification and all the things that it seems to be just, if you really know which companies you're investing in, you don't really apply?
I hope it doesn't happen. I hope. I think this is one of the few places you can take a class like this. It doesn't make any sense to me. It almost, I understand the math. If you're buying a piece of a business, it's just different than, who cares where what other people are paying for it at a particular time. I care about what the cash flow. Your risk is that the business turns down. The risk is that, they go from 1 million square feet to 200,000 square feet, and then out of business. With $60 contribution margin for each foot. You do have business. You're taking business risk. You're not taking volatility risk, or you're taking risk based on what is the income stream going to be. What are your coupons going to be from that investment? What are your earnings coupons going to be from that investment? That's the risk you're taking. If you understand that, and so you might want to have more than 5, you might want to go to 8 because you don't want to take that coupon risk from that business, but it has nothing to do with any of the measures, the volatility measures that are used generally to assess investments. It is true that people are influenced by those, and if you're going to be one of those people, then you want to know how volatile your business investment's going to be. Having said that, looking at past betas or past volatility really will have nothing to do with future volatility, so it's also suspect in that regard. You're making assessments that, when you're figuring out your standard deviation of your portfolio, the only good way to do that is looking backwards, which really is not that helpful, because looking forward, you're making these estimates that make the results of your portfolio construction pretty much worthless. And then, of course, who's done a cross-correlation matrix between anyone? Okay. I don't get that either. And it's very complicated stuff to do, and people do it all the time, and it's hard to do. But it's all based on assumptions, garbage in, garbage out, and I think most of the assumptions are garbage. And I'm not sure that the output that you're looking for to figure out how volatile it'll be over a 1-year period. Now, for instance, when Rich Bazzino was in here, if you measured his volatility, his standard deviation over 1-year periods, okay, his returns his standard deviation was equal to the standard deviation in the stock market, okay? So no benefit there. But if you looked at 3-year trailing periods, okay, just go 3 years, rolling periods. So you go January of 87 to January 1990, February 87 to February 90, and like that, 3-year rolling periods, then his volatility over 3-year periods was half the market. So which one should you, so everyone who does these analyses uses 12-month annualized standard deviation. Even if you want to use it, it's the wrong thing to use. Okay, it really should be using 3- and 5-year standard deviations over those kind of time frames. Then it may mean something. But even the way it's done, so I think the whole process is just, the efficient frontier and is just missing the boat, like, hugely. And I think it's taught because people have invested a lot of time learning the math. I think Haugen wrote it up. Said, big investment in this theory, and it's elegant. It just makes assumptions that are completely unrealistic and, not really that worthwhile in the real world. So I guess that's what I'd say about that, and I doubt that Buffett would, or I think he's specifically said that.
You shameless cloner. Want to track portfolios of famous value investors like Warren Buffett? See their buys and sells, current and historical holdings? Just visit valueinvesting.guru. It is valueinvesting.guru. Link in the description.